Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So today we'll go through the market update. I got earnings plan, Q1 2023. All that has been processed and pushed out to users. So we'll go through that and the results for Q4. And Joe's going to go through some ETFs. So that's the plan. Let's get started. All right. Fun week so far since the last meeting. Okay, indice wise, I mean, they're still in, SPX still in 6, which is kind of strange. That's a strange state, but been holding in there. I don't suppose that'll last much longer. Russell's in 2, NASDAQ 6, so actually not much change, but a lot of these, I mean, have gone, the sectors have kind of transitioned. We've got, pretty much all red here for the most part.
NASDAQ went to 6 for one day.
Yeah, that's what it knew. 6 is normally like a 1 or 2 day occurrence, very short, and a segue to 8. So yeah, definitely strange. Those 6s, we had a big, I mean, they're still pretty elevated historically. So we'll get into all that. Green pie got crushed, pretty much 20%. So, technically once we get below that 30, we're oversold. So, we're very oversold. And I'll go through that in the chart here right now. Like if we go, I'll do the bullish bearish first. So typically, if we go back, if we pull back here and go a little further, let me pull it back here. So like, this is like the typical, we get, like around 28, 29, it reverse here, touch 30, reverse, and that goes back like a very long time. So in the past like year or so, the lows have been, a bit lower, in my opinion, since this bear market started. We're getting down to like, below 20 here, below 20 here. So it's still like, here it got to like, 25. So it's still a good signal, like that 30, maybe a little more during kind of this bear market overall, but yeah, and I'm talking, sorry, I was looking at the wrong one here. I got flipped up on the green. So here's the green 30, below here 30. So this is when, the market started, and you can see the drops get lower. Sorry, I was thinking about something else and talking. These got down like 8 or 9 on the bullish, 12. This didn't get real close, but the 30, going back here, this was kind of like a typical here, all prior to, 2022, we get down around 28 and it reverse, that's the bullish market. Since then, these can get a lot lower, 11, 13, single digits. So now we're down in 20. So, the 30, green pie at 30 or below, I would, kind of put an asterisk, maybe 20 at this point, the way the market's been acting the last like year and a half. I would, kind of flag that. So obviously, and we can watch the highs too. So 88 here, about 88 there, 90 here. This one was nothing really, but if we get a big swoop, this is kind of like the ranges, and I think Joe's talked about this before, but we get up around upper 80s, that's typically when things turn back. So something to keep an eye on. We did have a spike in the lows here, so we got up to 441, so that's a decent sized spike here. And you can see back here, we got 442, down, up, and then like a big thing came. So, we always talk about these being like trimmers, kind of be careful, especially once we get like decent sized ones. So that was a decent sized one on Monday. I'm sure we'll have another one today. We had a little drop yesterday with market going up, but today should have a pretty big size one too. So these are rumbling, after a very quiet start of the year. So that stuff picking up. We did get a crossover on the SMA. We talked about that last week. Looked like it's going to cross. It did cross. So, this is definitely a bearish overall indicator. If I pull it back, you can see, so last time we had a cross here, and that was the beginning of 2022. Dipped and then crossed back above, but really, since November, of 2021, the reds were higher. Definitely ugly market since then. And then, this year flipped over, and now we flip back. So, as long as this continues, definitely bearish sentiment overall. If those, the reds are above the green there. So we'll take a quick look at states. Obviously, had a big move. A lot of things getting into 8 now. So with this cross back there, February 28th. So had a decent move up and then flipped over. So a little dead cat bounce yesterday and back down lower today. So I'd expect that to get higher today. Going back the past year, you can see the highs in these are upper 60s, lower 70s. If we have sustained movements. So that's the thing to watch for. Is just gonna have sustained downward movements like this, or we're gonna have like a little hilltop here. So just kind of monitor those levels. We get over 45, kind of range here. Back here you can see like 50, 45, topped out. So if we can get over like 50, then I'd expect it to, get a swoon at that point and try and rally up on around these levels. So, just kind of, keep checking the lows, obviously not looking good at all. We're getting near support levels. So, there could be a bounce area. So that's what we have to watch for. And we'll go into those in the charts. So, this is SPX state 6, very tight range here. Still in there, on average, I think it's like 2-3 days on average is what the 6s do. Been in there, over 2 weeks. So, we obviously got below the levels here. That target 3, but we did get up in the stops, turned around, back down, up, and I think we're down again today. So 3855. So we're below that right now. I would expect this. We talk it's like 2 weeks. We said I'm still expecting it to go into 8 at this point. Probability wise, it's pretty much pretty strong that it's going to go into 8. So once we go into 8, we'll see if it behaves normally, or if that's like a bottom type range. So let's look at the chart. So we'll pull out there we go. Let me get the tools. All right, so here's our 42, and then here's our 38. So we're getting down near that 38 level. You could see the last time it really got there, super strong support. So, if we get down there again, we have to see if that holds or breaks. you know, this is the current range, 38 to 42. Obviously on the low end now. You know, if that does break, then, you know, we just drop, you know, 38 to 34. So that would, this 34 level would be, you know, a new low for this move. It's the, I think the lowest here. So, you know, this is something to look for. You know, we're well below the 50. So if we talk about, we like to see this kind of, you know, support, you know, tried, you know, broke down here. But, you know, if it's a real bullish move, it'll show support moving up this 50 as it, you know, continues to climb. Obviously, we had to break down, you know, kind of turned into resistance over here. And now we're below 200. So we have to see if these are, you know, acting against, you know, any kind of upward movements. But in the meantime, you know, see if that 3,800 holds here on SPX. I think that's it there. Russell, obviously, huge move. Good call, state 2, you know, 1 day in, you know, hits all the targets. Well below there, I would expect, you know, I'd expect it to go back into 4, you know, since we're so low here. You know, so this 1743, we're below that now. Yeah, we're almost at 1700. So I'd expect this to flip to 4. Big moves down, but so, you know, as far as the range, I mean, it's on here too. So the 17's going to be very important. 19, obviously, is very important for a long time, and, you know, couldn't break it. And we'll just go into the chart and show that. Yeah, we held above it for a little while, false breakout, just like back here in August 2022. We had a false breakout, and then, you know, kerplunk, retest here, failed, and that broke through 17. Let me just draw the lines real quick. All right, so it's 19. We had a good run above it for a while, but, you know, never made it above, you know, this level. So we got close. So higher lows. You know, got into here. There's a pretty big fight, and, you know, we thought we had popped up, and then obviously turned around and crushed. So now the 17, big line in the sand here for the Russell at the 1700. Russell's just getting pummeled, you know, with all these small banks, you know, smaller businesses. They're not really that small, but, you know, compared to, you know, S&P companies, they are. But this is going to be a big line in the sand. You're going to want to watch at 1700. So I think it's kind of foregone conclusion. This is going to go 4. This will go to 8. You know, it's just a matter of, you know, this 3,800 and the 1,700. You know, are those going to hold? So that's where we're at on that. Treasuries, wild. Sorry, that's autoplayed. Wild moves, obviously, for the 10-year. So we're, you know, I always say that kind of like, at least, you know, that 3.5, it's been kind of like the line in the sand. So we're below that right now. You know, but we had this huge spike up, you know, up to the, you know, the 4s, you know, just crushed, you know, kind of with this whole banking problem going on. You know, another thing to keep an eye on is crude is getting destroyed the past couple of days. So into the 60s, you know, that's a huge move for crude. I mean, it's good, you know, at the pump, you know, it'll eventually trickle to us at the pump for lower prices, but just a lot of things kind of seem like they're becoming a little more unhinged than what we've been watching. So, okay, so let's pull up Fed minutes. Huge changes here. You know, last week we're looking at, you know, so we're currently at 450. Last week, it was pretty much 80% for a 50 hike. And then, the rest was a quarter hike. So now we're 50-50 between no hike and a quarter hike. And that's just because of, 3 banks failing, and apparently Credit Suisse, and we've talked about them quite a bit. I mean, that chart is insane. That credit, I mean, they're under $2. They're basically a penny stock right now, this Credit Suisse. So, from $76 to 2. They're still paying a dividend though, apparently. So there's not a bad yield either, 3.6. So terrible. I mean, they're apparently in big trouble. And that's a lot of the banks over there. We see those just haven't recovered, and I haven't looked inside their books, so but that's kind of just like this whole banking thing's kind of cascading. One I'm kind of watching is Schwab. I mean, that has some banking to it, but this is like a huge, I mean, for consumer wise, I mean, a huge deal. Schwab, I mean, this thing had a big breakdown. I mean, 40, this thing is like basically cut in half in like, a couple weeks. So, this is kind of one I'm watching. They've always been like a profitable type company. So I'm not sure why. I haven't seen too much on them, but that's the one I'm watching, because I think that affects a lot of people more than like some Silicon Valley, whatever bank. These other banks I've never even heard of. I think that one's, one I've been kind of keeping my eye on. So, all right. So 50-50. I mean, personally, I think we're going to do at least quarter. I think quarter's probably right now. I don't think we're not going to hike. I mean, we've been following the inflation numbers, like, they had pretty good readings today on that calendar for the PPI, but, yesterday, so like these PPIs were, like negative. Obviously retail sales dropped, not good either. So this one's like pretty much like, 0, they're expecting 0.4, this one dropped. Core PPI still 4%, but the one the previous day, so that was a little more encouraging, but the yesterday ones, still 5.5 core inflation rate, inflation rate 6, so these were pretty much on the number for the most part. So, I still think, they have to raise, based off all the rhetoric. Obviously, they're in a quiet period. So until we hear something leaked, I would assume a quarter. I don't know if anyone had a different opinion on that, but Joe agrees with me, like a quarter. Does anyone else have a dissenting view on that, or think it's going to be different than a quarter?
No, I agree. It's going to be a quarter.
Mhm.
Because otherwise, they if they go to no hike, I think they create a panic.
Yeah. Okay. Well, I mean, I'll go through my charts here, but it'll. I mean, there's a lot of things that are are kind of like the warning signs that things can get ugly. Well, I'll do that after this. So balance sheet actually gained a few billion, 3 billion or so. So the March lower continues, kind of like sideways down. This one up a little, but they have a lot of these kind of sideways weeks, but we're moving down towards that 7.5. I mean, eventually, that's kind of my line in the sand where, just based off of this previous one, this previous drop, that's where we ran into a lot of problems. Could be earlier, but just reference wise, 7,500. I mean, from pretty much 9 trillion. But we're already starting to see cracks in banking. So, all right, let me pull up some charts here. So it's a good one I saw for Federal Reserve. So they basically since the 80s, the rates have all come down. So they have the high end fund target, Fed funds target, and kind of like what happened here, savingsloancrisis.com credit. So that's 2008. So we're above kind of like the high end, the high target right now. And they already labeled it bank run crisis, but I think this is just the beginning. So, and then, they have the break point here, but you can see, when they're raising, they break stuff, right? That's what I've been saying for a long time. So it's a good chart. So this is another one, bank loan to deposit ratios. So like the reserve requirements, used to be like 10%. I don't even think there is one anymore, which is just a terrible idea, so these banks don't have to, they can, you deposit, Lee deposits, like $10 million, like they can take all that and buy, 10-year government treasuries yielding 1.2% 3 years ago, so like they take all his money and just, invest it in garbage, but the banks, just talking about that, I mean, they have to buy investment grade securities. So a lot of them are buying, like government bonds, like Apple bonds, like they have to be like triple B or above. So a lot of them just kind of revert to the treasuries, that's safe. And we talked about this, quite a bit. When the 10 years or 30 years were yielding like 1 point something, it's like, who's buying these? It's these guys, the Silicon Valley, morons. And, there's no hedging going on, So like when the rates go up and now the 10-year went from 1.2 yield, and say they have 8 years left on that, and now it's paying 4%. No one, I mean, you're going to take a huge loss if you have to sell that 1.2, huge loss. So that's what gets in the problems. They have so many of these securities, and if people withdraw their money, they're in big trouble. That's pretty much what happened. So a lot of banks in similar situations. JP Morgan looks pretty decent. The rest of them are over here, and loans plus securities as a percent of deposits. So you can see all these people have more than the deposits on hand. So this would be where they're talking about the reserve requirement being 0%. So I'm not sure how you can get 115, but typically it used to be 10%, so no one would be to the right of this line. So now they're basically encouraging all these people to take more risk, except for JP Morgan. Citi's right on the line below 90, so 2 banks, mega banks, and all these little ones are, this one's getting gobbled up, they're gonna just get gobbled up, for pennies on the dollar. And the big banks will say thank you very much. So okay, it's another one, that money supply growth. I don't know if I showed this last week, but we talked about M2 being the most important thing. So year over year we've dropped, like we have a -2 money growth. We'll see if that continues, but this hadn't happened since the 20s, 30s. No other time has it dropped like that. So yeah, so that's definitely something to be concerned about. If they continue to shrink money supply, could be big problems long term. This is the 2-10-year yield curve. So I talked about last week, we got really low, right? I mean, we had huge drops, like we were like over 1. Where is it? I think it's that one. Sorry. So it's like made a huge comeback. Right. So now it's 3-8 and 3-4. So what that tells me is that, okay, and I'll just fill in the chart here with my tool. Okay, so we dropped all the way down here and now we're coming back up. So when these things come back up, that's when the real trouble starts, right? So you have these drop down and then they come back. That's when the real trouble kind of starts for the most part. So we had a huge drop down. I don't think we got below 1.5, but we're definitely like in this kind of range. And now just a huge move within a few days, from like 1.2% to like 0.4. So not quite this, but huge move up. Disconcerting. I mean, when these things flip and start exponentially going up, that's big time problem, right? So we just have
Hey, Josh.
Yeah.
And the big time problem you're referring to is the economy itself?
Yeah.
Okay, because that's what I thought. That's what those gray lines on the chart,
Right.
they were all recessions and tough times. Just wanted to clarify that.
Yeah, it's like, okay, they broke something, and then the yields flip. Yeah, so as far as we know that, I mean, they're obviously started breaking stuff. I mean, this oil drops big, kind of concern. A lot of these things kind of acting together just are a big concern. Like we had these huge, I mean, Silicon Valley Bank is like the biggest bank failure since Washington Mutual, back in the great financial crisis of '08. So I mean, these things just popped up out of nowhere. 3 failed. They're semi bailing them out, at least the depositors. So very concerning. So that was it. Market wise, I'll open up to questions, comments.
Market's going down today.
Mm-hmm.
I think it'll keep going down. Now, Credit Suisse being the latest shoe to drop. There's probably
that's a big
coming.
one too. If this is huge. I mean, that's a monster. That's like a layman type thing.
Yeah. And there's probably going to be a few more. You mentioned who's buying these 30-year bonds at such low yields, or 10-year or whatever. Well, apparently a lot of these banks, fragile banks do.
Right. Yeah, and if they're shrinking the money supply, that means they're losing deposits because there's less money. Right. So it's just like a physics problem at this point, with gravity. Yeah. Oh. All right. Thanks, Adir. Anyone else? No? Okay. All right. Let's run through earnings. All right. Share drive. So, on the Google share drive, I put them all in there. You guys have access to this. So I'm not going to run through any of these. There's not like new people. So I did all the testing. They're available here if you want to go through them. I took out Mover because they never have trades. So it's just a waste of time. And
are the files labeled Q4?
oh, wait. Did I put the wrong ones?
Yeah, because I'm looking on the share. All I saw was Q4. I thought that was the last one. Shouldn't that be Q1?
Yeah, you're right. Hold on. I was in the wrong folder. I was doing the results, so I was using Q4. All right, this is correct. I know that. So there we go. There we go.
Okay,
Done. Good catch. Because I just deleted of Q4 and I put them back in. I was just in the wrong folder. I was in doing the results. So, all right. So let's go through the results. Okay, I tried to clean it up a little. I'm trying to make this better each time. Just make it more and more readable. From way in the past, I got rid of all the cents. So going through, thing by, trade by trade, bullish pre-runners. So we had 16 that were non-confirmed, didn't populate correctly, or, on the supposed date. And, we've had that for quite a while. I don't see that ending in the near future, but we did have 18 total confirmed trades, 17 and 1, obviously, pretty similar, 94% from, the previous quarter here. That you had the one loser, and, overall very strong. It's been our strongest one, so overall. And we've had good markets to do it. So when we release this, we typically, let me just pull up SPX. So we like to see like kind of like this kind of time period. So like this is like an earnings plan release this week, the 13th. This is another one. It kind of hung low and then rallied. Here, this is kind of the release week, and we get runs up. So, we'd like to see within a couple weeks that at least the market's bottoming. So just if it's or flat, and then we can get pretty good results on these. We've had a few bad ones. I think it's quarter one. Yeah, quarter one of 2022. And then like before that, it was like the taper in 18. So just something to be aware of, typically, as long as we're not like free fall, they'll do pretty well. So volatility rise 2, one was like a, Disney was a good trade here. The other one like barely eked it out, but they both won, better than last quarter, obviously, but a lot less trades. So when the trades don't work out, they don't populate the next quarter typically, unless they were 100% winner. Then we give them one more chance. But if they were 90% winner and they lose, then they're not going to populate the next quarter. So we got 2 available here. Ball crush, there were 2 overall. These all did really well. The iron butterfly trades between the non-movers. This one, typically, we have a couple big losses in these non-movers, like $2,000, a couple $1,000 losses, but this time we didn't have any. We just had a small loss. So these did really well overall. Probably the worst one is going to be the bullish runners. So there's 2 trades still active, and that'll probably turn this negative, I think, marginally negative for the quarter. So, this one did really well last quarter, but, this quarter is pretty much going to be down a little. But, everything else pretty much made up for it, including the bearish runners, which were very impressive 5-0. So, it seemed like, market did well running up, kind of at the end of the earnings season. These things, it was more of a bearish, slant than the bullish slant. So it kind of flip-flopped here. But overall, between these two, you probably break even, I would say. But overall, still, solid win rate. Better than last quarter. We had 78, we had 86 here. I think we had less trades. We had 69 total trades here. We got 57 total trades here, but overall real good quarter. So, hopefully we can repeat it. If we get like a market bottom in the next couple of weeks, I think, let me pull up earnings plan. Let me just close this stuff out.
We need that market bottom around the earnings plan release date, huh, Josh?
Yeah, I mean, within a few weeks.
Right.
Yeah. So, I mean, you want it today, but like, I think next week is the first one. Yeah, the 21st. So, I'd say by the 28th, you kind of want to get, at least, market bottom by then. And then it should be a good pre-runner season. So, we got a few bearish pre-runners, like two. I didn't do all the counts, but the numbers are down a little from the previous quarter overall. So, but you can look those all up in the share drive. And I don't think I shared this yet. Let me send this out. And if you don't get this, if you don't get this plan email, just send me an email and I'll make sure that you get added. It's just this group gets it. It takes a while, so I'll open up.
When does it go out? I didn't get one today.
Oh, I'm just sending this email right now.
Oh, okay.
Yeah. So it'll release, so then you can pull up that plan on your login. It takes a little bit to, there we go. Okay, so everyone should get an email. If you don't get it and you don't get access to this earnings plan, just send me an email. I'll get you on there. It just takes a little bit because it's sending it to a lot of people. All right, you guys have questions on the earnings plan? Comments? Anyone trading it?
I'm trading it. Yeah, I did pretty well. Yeah. Didn't bring the numbers with me, but yeah, it worked out fine.
Yeah.
I'm generally avoiding, I still stay between 1,000 and 1,200 risk per trade. So some of them they required more risk than,
right.
Like you have bullish runner here, max risk 4,400.
Right.
I would have never taken that one. But or I lowered sometimes it's pretty wide between the strikes. I lowered it to reduce the risk.
Yeah.
But yeah, it's working fine.
Hey, Josh.
Yeah.
Hey, I hear a lot of talk watching the business news that earnings are expected to go down generally for all companies this coming quarter. How do you feel that affects the earning trades?
Well, I mean, honestly, they have been kind of, they've been lowering them over the, from estimates, they've been dropped, but it's just a matter of, okay, now where's it at? And then, going into the, so they'll set up, whatever company, let's just say, travelers and insurance, right?
Yeah.
So like, last week they lowered their estimate, right? Okay, so that'll be already reflected in the stock price. So, I don't think, within this like short window, of the pre-runner that, they're doing a lot of, I think their estimates are already kind of in the playbook at that point, going in a couple weeks before earnings. So, I think they're still like, okay, we'll still think they're going to beat, and they lower the estimates for these companies so that they can beat them for the most part. I mean, Joe's like 67 to 75% beat, right? So
exactly.
Yeah. So
that's what I've noticed, is that the reason that this works is that companies are smart enough to lower their estimates lower their earnings estimates before the announcement. That
Mhm.
causes their stock to drop.
Mhm.
Then in the period where they're bullish pre-runners or whatever, they beat the lowered estimate. You know, the rumor goes out that they're going to beat it,
Right.
even though net the earnings went down.
Right.
They're still beating the new lowered estimate, and
Right.
causes this bullish pre-runner or bullish runner phenomenon.
Right. Some would call it financial engineering.
Yeah,
I
financially,
would.
the earnings, raw earnings year over year can still be down. And I've noticed this, but they can still be a bullish pre-runner or bullish runner. It's
Yeah.
amazing. Because of the way they do their announcements.
Right.
All
Does
right,
that
thanks.
answer it for you, Lee?
Yeah, that's good.
Okay. Thanks, Sadir. Okay. So everyone got the plan shared out. All the files are out there on the shared drive. So everyone's set up, and the earnings, first one, well, they're still estimated. So yeah, I only trade the confirmed ones in the portfolio. So yeah, outside of that, it's up to you guys. But got a few confirmed. Yeah, that one just confirmed. So hopefully we get more confirmed. But Joe and I are talking. We'll probably expand our liquid lists. I think it's like 350 right now. So we're due for a review of that. So maybe next quarter we'll more in the liquid list. But should be good. Any other questions on this before Joe goes?
Well, thank you for doing it.
Yeah, it's fun. Fun to yeah, especially for making money. All right, Joe, you ready?
Or Josh, I'll pull up a couple charts.
Mhm.
Let's see here. Everybody, and Lee, what you said, before the start of the call, I mean, just credit to Josh. He's been talking about, these things, be it the something breaking, the liquidity crisis. I mean, how many months? It's probably 6 months. So really, Josh, you do a hell of a job, taking the various parts of the market, breaking it down into simple terms, and then, offering good guidance. So well done, man.
Yeah, thanks, Joe.
Is one of the areas where you're, very good at what you do. So here's the new UI. Josh has pulled this up from time to time. Just again to give you a look at where we're headed eventually. Some different things here that actually we won't have next week's meeting. Originally, obviously, we weren't going to have today's meeting. Our plans with Ashok got pushed back by a week, so we won't be meeting next week. But in 2 weeks, we not like we'll have this thing ready to roll out per se, but hopefully we'll have some really solid conversations with Ashok next Tuesday and Wednesday, and have more to talk about in terms of the new things we're doing a couple weeks from now. Let's see, just in terms of, so again, this will be, the new look or something close. Going back to Russell, obviously in state 2, bottom right here, 64% chance that we're going to roll into a state 1 coming out of state 2. So that remains to be seen. Russ asks from time to time about, the wave counts. When I look at this chart, I actually see, the potential for a 5 wave coming out of the highs February 2nd. We had, a 1 down 2. This last leg, which was actually just a crush over the last week, looks like a leg 3. Maybe we go sideways for a little bit for a leg 4, and then we'll see whether we get a retest, into a leg 5. One thing about the new lows in Russell, we have exceeded, any of the retracement levels for sure, where we have not in SPX or NASDAQ. I mentioned to Josh today, I read something yesterday where there was a suggestion that the Russell is bank heavy. The Russell index is bank heavy. I was unaware of that. Maybe some of you think that's the case. That may explain why Russell got, so crushed over the last week to some extent. Trying to hold these old lows. Actually, we've broken through these lows, I think, today. This was 1722. We did get down below that. We'll see whether we can hold these lows back in here. We're 1641 from a retracement level. We're in no man's land. We've exceeded the retracement. So that's Russell. Again, it'll be interesting to see if, we roll into a state one coming out of this debacle. From a day perspective, state two just on average 8 days, a lot of occurrences, almost 60 occurrences over the course of the database. So, the next few days, as Josh was suggesting, will be awful important. SPX, state 6, there's a 70% chance that the next state is 8. Josh was talking about that earlier. From a retracement standpoint, and I'm going back, to the lows, let me see, of October 13th, we have not exceeded retracements in either SPX or NDX. I don't get any 5-wave counts here. We're just kind of see, as Josh was saying, seeing if we could hold the 3,800 level. The low the other day was basically just above that at 3,808. The retracement level, as I pointed out, last week is about 40 points below 3,800 if, we're to have another leg down. So remains to be seen, what happens in Russell and NDX. I mean, it's just staggering. Again, I mentioned last week, NDX rallied 21% from the start of the year. We went from 10.4 in October to darn near 12.9, in the beginning of February. So from a retracement standpoint, we've pulled back to about, right about 50%. And, it'll be interesting to see, whether that holds or not. I'll tell you one thing that surprised me when I was going in to look at the charts today. I was darn, you wake up this morning, the Dow's down 500, 600. I was darn surprised that today's lows, with the exception of Russell, are really well above Monday's lows in many instances. That surprised me. I was thinking, we'd be testing or making new lows now. That has happened in Russell, but not in the other indexes, which, as I said, really surprised me. I can just kind of rip through the various ETFs. Over the last, I guess it's 3 weeks, past couple of weeks, we had 4 bullish states, 7 bearish states. That has, basically gone from 4 and 7 to 10 bearish, 1 bullish at this point. Not too many real takeaways. I mean, I think the industrial sector, which, what do we got here? 65% chance state one is next. It's holding up pretty well, as we talked about. You got kind of a trading band going back to last November. So we'll see if this thing holds. Still pretty constructive. Actually, let's go back and check day-wise. State two is quick, but again, a lot of occurrences, in state two. So the next week or so, be interesting to see what happens, what kind of transition we get. The consumer staples, they rolled into state 8. I guess that was about a week and a half ago. Same thing. Looks like, Friday, Monday were the lows, trying to hold up, obviously a downward trend. 95% chance that, state 7 is going to be next. But, whether that turns into what Josh likes to call the death spiral, 8787, remains to be seen. From a day standpoint, we still got a solid 2 weeks plus on average, in state 8. Consumer discretionaries, one that I thought, bared watching, kind of just sideways down, has rolled into state 8. And, from a day perspective, maybe another 3 weeks. So just, I thought that'd be an interesting watch, coming out of last week. And, we'll see if leg 8 or state 8 has any legs. Of course, the financial sector, what a week. And I got yesterday's Wall Street Journal headline. I don't know how many of you get the Journal, but when I see a front page headline that says bonds post biggest rally since 1987, as I was mentioning to Josh, I mean, that shakes me to the core. I mean, I was on the trading floor back during the crash of 87. And I think I've mentioned before, I mean, you couldn't trade bonds that week. It was lock limit up in the bond market all week long. That was pre-internet, market bottom. Basically, I guess that Monday, the 19th, but really on a pre-market basis, the market bottomed. It was Thursday morning. The Dow had bottomed in 87 around 1700. It was well into the 16s Thursday pre-market, but then, who knows what happened, and it rallied. But, when we start making references to the bond market, the biggest rally in the bond market since 1987, it just tells you how, historic, the movements in interest rates have been, in the last week. And it really, as I say, shakes me to the bone. Is it going to be an incredible buying opportunity? Again, I guess the
What do you
numbers.
think that means, Joe, for the market, stock market?
Sadir, I honestly think the market's holding up remarkably well in the face of this, and I think so. I'm somewhat optimistic, and I think it's not really systemic. I mean, there are going to be other banks. I think one of the things that I see is the biggest concern here is, why didn't they let Silicon Valley get bought by, supposedly the people who were interested out there, in taking it over and having the Fed come in and backstop, all depositors, in the banking system. That to me is probably the most problematic thing I've seen this week in terms of the action of the market. I think it's pretty decent given the fact that, given what's happening. Certainly there are dislocations, but I'm somewhat optimistic that, maybe we are going to, roll into a bottom, as Josh says, sometime in the not too distant future. Certainly, now 87 is just one example. That certainly was the bottom. Let me see, I have, see if I can pull up another email that I had here. I think it's gone, but so anyway, that's my thought on this at this point, Sadir. I'm thinking, the markets are behaving pretty well overall. So, I remain kind of optimistic that we're going to find a bottom over the next few weeks. I don't think, certainly big earnings revisions to the downside because of what we've seen haven't happened. Will there be some contraction, in business? Probably. Josh was pointing out, the retail sales number was down, but, right now I'm somewhat optimistic that we're going to find a market bottom in the next few weeks. Time will tell. As far as, just the other ETFs, we have rolled into 8 in healthcare. That's kind of been in a downward slog for quite a while. Can't really call that a 5 wave, although that's kind of what was jumping out at me. December, you got leg 1 down. sideways into 2. We've kind of meandered down. 3 is supposed to be the most violent way, but it's certainly been one way. You know, maybe you had, you know, back in late February, you had, you know, the bottom of your third leg, quick rally in 4, and maybe this is a 5-way. So I'd look for healthcare possibly to be bottoming out around here. In terms of, we still got to think, what, a couple weeks? 3 weeks in terms of the average period of time in state 8. So I haven't really talked about this too much, but and I'm not sure that you're looking for leadership in a market coming out of healthcare, but I think maybe a couple constructive things going on in this particular ETF. We got real estate, you know, not a surprise that it's in state 8, just kind of slogging along. I would assume that's going to continue just to kind of go sideways and be a trading range. Time-wise, got, you know, a week there before, on average, we roll out of state 8. What else? Excel, you know, the materials, just kind of trading range, you know, obviously with some, you know, fell out of bed after a state 1. So we didn't get to break out of that 85 range, got a hell of a correction. I think that's another important one to keep an eye on. And utilities, you know, no real surprise, just kind of slogging along, not much there. A couple more. Energy, Josh was talking about how oil's fell out of bed. Be interesting to see if that becomes a tailwind, you know, for inflation here with if energy keeps falling. You know, state 4, what do we got here? Just a couple weeks there, and then we got one more. Yeah, the one bullish one, we talked about it last week. You know, they was talking about, you know, rates and how, you know, the technology stocks, you know, higher rates are really a significant headwind. Obviously, that's kind of reversed. This thing's held up pretty well in state 1. Still got a long way to go from a time perspective. So again, this is another one that I'd be watching just to see if we're going to get a bottom, if maybe this is where the leadership's going to come from. So they were the charts I wanted to go through. I had an email which let me see if I can find it. Just yeah, here we go. Just the magnitude, the 3-day move in the 2-year Treasury yield, and over the last few decades, and this doesn't include, you know, today's move, which is again, you know, humongous. But you know, we've got just really 4 instances, and you know, over the last 3-4 decades, and you know, we're right there now. So you know, Lehman, Black Monday, you know, the Fed target rate, that goes back to the early 80s, I guess. But back to your question, Sadir, you know, Black Monday turned out to be a market bottom. Lehman, you know, that was September 15th, I believe, 2008. That was not a market bottom. We didn't bottom out until a solid, you know, it was early March of 2009. So we had a 5-month period then before the market ultimately did bottom. So whether it's over the next couple of weeks or the next few months, I think, as Josh suggested, you know, we're going to be finding one. And, you know, I guess that's the question. Is it a few weeks or 3 to 6 months? Time will tell. So, happy to take on any comments or questions. And if not, Josh, we'll turn it back to you gladly. And thanks for, you know, being ahead of the curve with so much of this, you know, over the last 6-12 months for sure.
Sure. Anyone got any questions for Joe or me before we close up? All right, all quiet. Okay, so yeah, next week we will not have a meeting. I'll just send a reminder that Wednesday that we won't have it, but we'll pick it up the week after that. So, all right, thank you all.
Thank you.